next panel up is some of the top SaaS VCs talking about how to grow 20% month over month. And the moderator for this panel is Jason Lemkin, who started SaaSter.com, which is one of the leading resources for anything SaaS. So if you're interested in that, you should also come to the SaaSter Annual in February, and I'll let him take it from here.
So I think we have an all-star panel here for two reasons. We've got three of the best SaaS VCs in the industry. We're going to talk about it. And not only do we have three of the best, we have three that, having been both a founder and an investor, that I would actually take money from, and in one case have, which is a minority of VCs. So I think we've got industry luminaries and folks that I would back and believe in and take money from. So I think it'll be pretty interesting. And I want to talk about a couple things. One, what's happening in the tool space and in sales solutions and marketing solutions, because we're here, and also what's happening in the market in general, because these are just pretty interesting times. And so let me just introduce the folks briefly to the left, and then feel free to add in. Jason, to my left, Jason Green, who is also my investor. I did not realize he's backed 7 unicorns so far in his career, so that's pretty good, right?
I've been around a long time.
You've been around, yes. In less than 32 months, he's backed 7 unicorns. But Jason, as you know, or as you may know, co-founded Emergence, and so as early as you can be doubling down and just being focused on recurring revenue and SaaS businesses, that's sort of what Emergence was created to do. And so a lot of neat companies, basically all SaaS, all B2B. And so Jason's salt of the earth, so I'm excited to hear what he has to say. Tomasz has a blog maybe one or two of you have read. I'm really grateful to him, as I often say, because he does the real work. Like every morning at like 4 in the morning, he'll read like the Atlassian F1 for 7 hours and post all the data. And then I could just do like one tweet about it. So it takes me 60 seconds. And he's been up since 4 in the morning doing the real work. So in addition to being a great investor at Redpoint, he's contributed an enormous amount to the community. So it's fun to have him here. And then Stacey has been investing at Scale. And Scale is one of the leading well, I guess all these letters change. A, B, C, F, 1, 2, 3. Leading Series 2 and 3.
Early in revenue.
VC, what's that?
Early in revenue.
Early in revenue. And Stacey's done an A-plus list of companies. She did HubSpot very early, I think, right? That's a good one.
2009.
Right? 2009. We'll talk about some of our other investments as well. And I think it's a rock star panel we've got here. And so I have a lot of stuff that I want to talk about. And I will mix it up. But first, what I thought would be fun would be to hear from each of our folks about one sort of sales or sales-ish or revenue tool investment they've done in the last 24-ish months, or the firm has done, and why. And in many cases, a lot of these tools or solutions or products were too niche-y or too small, or things have changed, and we're in this different world. We're all here, right? And we were just talking about the panel. I think Jason was saying there's like, or maybe it was Stacey, there's like 3 times more people than were expected here, and everything's bigger, right? So I want to learn what's different from an investing perspective, and then let's time it into what's sort of, or tie that into what's in the market. So Jason, tell us an investment you've made recently and why you made it.
Sure. So as you guys can probably tell from downstairs, there's a lot of companies in the sales acceleration space, which is great for this conference, but it's a little confusing, both as a customer sometimes and certainly as an investor. Try and figure out which are the ones that make sense to bet on. It's even harder, actually, as an investor, because not only do we have to find a great product that can get value for customers, but we have to invest in something that has sustaining value that you can build a real business around.
Yeah.
And I guess our philosophy at Emergence, having looked at a lot of companies in the space, is that you've got to be a platform of record, not just a solution on top of another platform of record. So we've looked at a lot of companies that are building on top of Salesforce, for instance, to make it easier to slice and dice the data there or get better access in terms of inputting the information or getting information out. I think the problem with that fundamentally is that you're not really owning your own destiny. So Salesforce can build something on top of that probably in a few months, or certainly in a few, sometimes even fewer than that, weeks. And then all of a sudden, you don't have a sustaining business model. So for us, there were 2 companies we've invested in recently. One, SalesLoft, which is downstairs, and I'll let those guys talk about the company themselves since they're here. Another one, which isn't, is called SteelBrick. And what's interesting about both of these companies, they're both kind of on sitting on the sides of CRM. One is at the front end of the process, managing all your prospects, which become opportunities and get into your CRM system. And the other one is at the end of the process once you've actually closed a deal. So how do you manage the quoting and invoicing process at the end of the sales process? So they're both platforms of record. They both have their unique sets of data. In SteelBrick's case, we love the team, which is obviously a huge thing for us. We're betting on, in that case, a guy who's already built a company and sold it to Oracle for $400 million. This is his second time round. He wants to ring the bell, as he said, and build a big business. So we love that. We love the fact that he had a product that had significant customer adoption and traction. And then third, there was really no leader in the space. There's some other companies in the space, but we love to bet on market leaders. So our belief was with his talent and team, a great product, and then our fuel, that he could build a market leader in the segment. So we're super excited. That company's gone from maybe 5 people when we invested 18 months ago. They're at 200 people today. So
how long and how much time? Sorry, say that again.
18 months.
18 months.
Yeah.
Got it. Yeah.
And they've more importantly driven the top line in terms of both customers and revenue to support that growth.
And how much did they just raise? Like $50-some-odd million or something?
They just closed down around, yeah.
Something like that,
Yeah.
right? And that's probably more than Big Machine's ever raised in its decade-long history or something, right?
For sure.
For
Yeah.
sure, right?
For sure.
So a lot changing, right? And one question on that, I don't want to take all the time up on SteelBrick, but it is interesting because Godard is sort of doing the same space again. I'm sure there's many nuanced differences,
Right.
but if you have the right founder with the right experience that had a $400 million exit, should he be able to have a $4 billion exit today because the markets are bigger? Is this silly SaaS math, or is this real stuff?
No,
right?
it's real. It's real.
Yeah.
And it's the cloud, obviously,
Yeah.
and the market size and opportunity. He thinks that he can build a company that's orders of magnitude bigger than Big Machines.
Yeah, I think so.
And that's hopefully what we're betting on.
Yeah, and it's early in the grand scheme of things, but it's growing far faster than the Big Machines did, right?
It's growing,
At least much faster.
It's kind of
right?
it literally is it's dog years. It's condensing. I think Big Machines has grown over 10 years, and he's probably at the same run rate he was 5 years in.
Yeah, yeah,
So
that's what we're
pretty
seeing.
incredible.
Yeah. So Tomasz, give me an example. Give me a red point or other example that's in the general space.
Yeah, in the general space, I mean, one company that I'm really excited about that we invested in about 18 months ago is Looker. And Looker is a BI tool, and it has a very interesting sales-specific use case. And there's a case study on the Looker homepage with HubSpot, and which is a great company too. And the sales operations team at HubSpot actually uses Looker, which is a BI company, to tell salespeople exactly how they're performing on 4 key dimensions of their compensation plan at any point in time that they would like to know about it. And at my understanding, I mean, Stacey, you would know better, but my understanding is the sales team at HubSpot really cares about, obviously, quota retirement. Mm-hmm. They care about deal terms. They care about months of cash up front. And then they also care about, what was one more factor? They also care about churn. So whether or not a customer actually leaves within a particular period of time. Right. And all those calculations actually sum up to the salesperson's compensation. And what a lot of people do with Looker is they attach it to Salesforce or whatever their CRM record is of choice, and then they actually provide a lot of sales operations insights or similar data to their salespeople. And so that's a company that we were exposed to at a bunch of different board meetings of other portfolio companies. We saw it. We got really excited about it. And the founder there, he's a wonderful guy. He has the distinction of building the first application server ever. And then he sold it to Netscape. And so he kind of rode that wave.
Got it.
And he ended up building the same data platform over and over at 3 or 4 different startups that he founded. And then he finally decided, I'm going to build the one that I should have built from the very beginning.
So a question on Looker. And I should know, I mean, I know the company, but I don't know the product, right?
Yeah.
And so the sales op folks are literally writing SQL queries themselves to access this data,
No,
right?
well, so yeah, it's a sales operations team.
Yeah.
And it understands how the data is structured.
Yeah.
They write it once, and then everybody else in the company can
Just runs the
manipulate the
report,
data
right.
as if they knew.
So
that
let's talk about a market size tool question, right?
Yeah.
So what's happening in markets today in 2015? I mean, you invested 18 months ago, where that's a big enough market, right? Obviously, BI in general is big, but what you obviously saw that this could be a unicorn, right? So what's driving, why, and what's the price point at Looker on average? 10 grand a year, 15 grand?
It's a little higher than that. It's between 20 to 40,000 a year.
Okay.
Maybe a little higher now.
Right. So what's the decacorn story here that's different than a couple
Well,
years ago?
Well, the decacorn
right?
story is, yeah, the stack in BI has changed. And so what ends up happening is you used to buy your BI with a database, a data cube, and then a modeling, a visualization layer on top.
Yeah.
And you did it because databases were super expensive back in the day. That's no longer the case. I mean, you look at Redshift, it's really cheap, scale out, BigQuery, Azure Cloud. And so as a consequence, the stack of BI that you're going to buy has changed. And so you need a new tool on top. And what most BI vendors do is they really just they expect a fully formed, perfect data set. So Tableau and a bunch of other companies are in this case. And Looker takes a fundamentally different approach that basically models the data. So it takes what's in the brain of a data scientist or an analyst and lets everybody else manipulate the data as if they knew what the data scientist knows.
Got it. Okay, that's cool. So Stacey, tell us what one you've done that's emblematic of this change.
I'll do two, but I will be quick on them
Two's
both.
all right. Jason snuck two
I know
in.
exactly. He started
did a
the
good job,
pattern, so
right?
I thought
Yeah.
I'll do the two too.
Yeah.
So we have one in Aviso, which is in the sales forecasting space, and now it does sit on top of Salesforce, but looks at the data.
Is Jason wrong?
Who knows? And brings a predictive element to it. So it was a pain point that we spoke to a number of VPs of sales, even in our portfolio company, outside of our portfolio company, huge pain point, the whole process of trying to snapshot and do the forecasting and understand what's happening and be able to take action on it early enough in a quarter where the quarter can matter, particularly for companies on their way to going public or who are already public. So we had a number of portfolio companies already using them, so really excited. I mean, there's customer love. That's what we really liked and got us excited about the opportunity. And then the other one is in a company called Visible, which is in the marketing attribution space. A little bit different, but it understands where your marketing spend is having an impact on closed deals. So not just telling you, oh, this was a click-through, or this turned into a lead, but understanding it all the way through the funnel of what is impacting closed deals. So again, another pain point, the marketing channels have exploded. To get a sense of where all of your spend is going is just super helpful for companies to understand how they can best optimize the money they have.
Yeah, and let's talk about those two for just a second. I know both the founders of both those companies, and they're great, right? Were those founder bets as much as anything, or are there changes in the marketplace? Or,
we
right?
were looking for them in the market, and we always try to find, the good founders. I mean, our theory is go after the market and then try to find the best team going after that market. So we believe that markets determine the outcomes. Team determines whether you can get that number one position or not.
I got it.
So that's what we're shooting for.
Okay, so let me ask the first. So why are like dashboards exciting today?
I just think the world has
Because
gotten
a lot of people here are
complicated.
selling dashboards or trying to sell dashboards,
yeah, it's
right?
complicated, and understanding where your money's going and how to get more insight into all the data. I mean, just think in the last 10 years how many channels have exploded. You now have social, you have email, you have mobile, you have web. It's no longer a simple world of where maybe 15 years ago it might have just been your website and understanding that traffic. You've got all these other places you need to track and track all where all the money's going and understand how to optimize it. Plus, the marketing budget's gone up significantly, and marketing's become more important on the impact in sales. They should be tightly integrated, and you should understand that the marketing spend is impacting your sales and your outcomes.
So is it a shift of buying dollars, or the buying dollars growing?
I think the buying dollars are growing in marketing.
Yeah. So let's chat about, then let's tie into the Uber theme. So what's driving that? Why? I mean, companies only have so much money. There's only so much, there's a lot of money to spend on IT, but what's driving that shift?
Well, I think there's a whole shift where now products are no longer sold, they're bought. So buyers are going out and doing all kinds of research, and they're very knowledgeable before they engage with the sales rep. And so marketing is driving a lot of that and putting the information out there through content marketing, through the social channels. Especially in developer marketing, it's all about content marketing. You can't just cold call up a developer and expect them to buy. They have to know about your product, be aware of it, be able to download it, try it. And so that's just becoming a critical element in the whole process of the sales machine.
Yeah. So let's chat a little bit about what the bar is in 2015, because my thesis is that it's gone up, right, over the time we've been doing this SaaS stuff. You have to do, it's great that Steelbrick is doing better than, Goodard's previous company. Big Machines, but it had to get emergent. So I want to talk about that. But before I do, and Jason, let me ask you about that first. Tomasz, let me ask you. Then I want to come back into this question. So Atlassian, right? Yeah. So we're here in a sales conference, right? So should we all be seduced by getting to 300 million in revenue with no sales reps? Is that reproduced? Should everyone in this room be fired? Like, what do you think? Because you wrote the
I think
post
you
this
should all be
morning,
given a
right?
raise
How many
and
Atlassians are we going to have here, right?
So I think Atlassian is an exceptional business, but I
Yes.
think it's in large part a moment in time business.
Yeah.
And Kenny Van Zandt, who's the CEO of Asana, kind of coined this term. Talks about flywheel businesses, which are basically companies that generate revenue even when no one is working, right? And they do this mostly by acquiring customers through product and marketing and moving them through an upgrade path through product and marketing. And Atlassian is one of the great examples. SolarWinds, another great example. Two publicly traded companies. But I think for a flywheel business model to work, you need two different things. The first is you need a buyer that is very difficult to sell to. Because if a buyer is easy to sell to, then the traditional channels work just as well. And the second thing is you need very little competition in the space. So imagine, do a thought experiment. Imagine marketing automation. Let's say you're going to do next generation Marketo Eloqua, right?
Yeah.
You've got one company that does the flywheel business model that decides to do mostly by product, bottoms up. And you've got another company that raises a ton of money and basically coins the category, hires a sales team, defines the category, creates the conference. The second one, in my view, is going to win 9 times out of 10. And that's just because the awareness that that company is going to generate is going to allow them to dominate the category. What's going to end up happening is the business will grow faster, they'll be able to raise more capital, they'll hire more salespeople, spend more in marketing, and that's a flywheel in and of itself too.
Yep.
And so I think Atlassian is an exceptional business, but I think it's a moment in time company, and I don't think you could go to market the same way today and replicate the success, because the competition today is so much more intense, and the availability of capital is much greater than it was.
So you're not looking for the next Atlassian as much as you'd love to invest in it?
I mean, when I find it, I will invest in it.
Yes,
right?
no, understood.
Whatever I can, but I think it's going to be rarer and rarer to find those kinds of businesses.
Yeah.
But what I feel like we're seeing is a combination business model. Like as far as a go-to-market strategy, take something like DocuSign, where you're using a freemium. Well, EchoSign. You're using a freemium business model to go to market to generate leads.
Yes.
So EchoSign, same thing, but using multiple business models, where you might have the freemium model, you might have inbound sales, and you have a direct sales. So what we're seeing is companies doing all of those to go to market. So it's not just it's Atlassian plus. Adding if they're doing, end-to-end sales where they're selling at the high end and the low end, where you might have all the kind of different go-to-market strategies.
Yeah, I just find we used to call it the 37 signals or the Basecamp model. Now we're all going to call it the Atlassian model. It kind of confuses people, right? And a lot of folks say, can I replicate that in my quote to cash company, my 7-figure, probably not, right? But that's a good point, right? There's elements of this that we're going to work in every business, right? Even in Box, right, where you're both investors. I think Aaron said recently, I think that freemium is like less than 1% of the revenue, or maybe it was in the public statements, but it's still a material source ultimately of marketing and lead generation, right? So Jason, let me go back to this Uber topic, because it impacts so much of what everyone does, the bar, right? And I actually, 2 years ago, I was at an event with Rory, who's Stacey's partner, and he was talking about what the bar was 2 years ago, and I had been out of the game. I'd been an entrepreneur who'd sold my company and was like doing nothing for a while. I don't know what I was doing, blogging. And he sort of talked about the bar, and he didn't say it as crisply, or I don't know exactly how he said it, but it was an eye opener to me. It's like you kind of want to like go from 1 to 10 in 5 quarters, right? Which and in the old days, you'd want to, whatever the math was, you'd want a triple and a double and a double and a double. And if you had a double and a double and a double and you were patient, you could make up for not having a triple, right, if you're committed. So, but I don't think you can get funded today as a double and a double and a triple and a double, can you?
Well, it's kind of, it was interesting to think about Atlassian, because it's not typical to find a company that grows that fast without the sales and marketing engine on top of it. You need to have the capital, basically, to accelerate the business. And today, the thing that's different about today is the availability of growth capital at unprecedented valuations that we've ever seen before.
Right.
Yeah.
So if you combine the market opportunity, the cloud, which makes building the product a lot easier, with the availability of private capital to go in and accelerate these businesses, Like that's just resources that you've never had available to you.
Yeah, the growth capital is stunning, right?
It's stunning.
It's stunning.
And then you have talent. The talent that, the number of companies, we're recruiting like the guys who are on company number 2 or 3 of their SaaS business.
Yeah.
They already know the routine. Yeah. They already know the people they want to hire. They already know the systems they want to put in place. They already know the process. So we can just, accelerate,
right?
Accelerate faster because we're not going to make as many mistakes.
So but let's ratchet that back a minute, and I'd love to hear everyone's thought on this because it's important. So second-time founders, I get it, right? Product market fit, always hard, right? But once you have it, second-timers can just, especially with all these extra nickels floating around, can just accelerate it, right? But especially if I'm a first-timer figuring out, if I'm at $1 million in revenue, or pick 2 numbers if you want, 5 million, because Emergence does a couple stages, everyone does. How fast do I have to be growing? I know I'm trying to make something quantitative that's a little qualitative, but if I'm growing 6% month over month, I'm not going to get a second meeting at Emergence at 1 million ARR, am I?
It's very hard to give you a specific quantitative answer there because there's so much of it is the magic of the team and the market opportunity. Yeah. But our best companies right now are growing at rates of 3 to 5x, per year, right? Yeah. So if you aren't demonstrating that, there better be a reason why you can get there at some point, right? So the doubling year over year is not interesting anymore.
Yeah. And so, Stacey, if I'm working at a company that's only doubling year over year, right? This is the curse of the middle, right? A company that's even, let's say you're growing 60% year over year at 4 million, like that's pretty hard to do, isn't it?
Right.
I mean,
it is.
So what world am I living in if I'm growing 60% at 4.32 million ARR? Yeah, what should I do?
It's tough. But there are a couple of caveats I'll make. One is I'd have to look at what is in what the market they're going after and what have they spent to date. Have they spent very little capital, and has it been all inbound where they haven't even turned on an outside sales model in any way or done any outbound marketing whatsoever? So if you think that you can apply capital to it and make it grow, it's hard to accelerate growth. Occasionally it happens, but maybe maintain that growth rate. Yeah. Perhaps it's there, but the doubling I'd want to see a tripling at $1 million run rate, and then you'd want to see more like a doubling at a $5 million, at least a doubling at the $5 million run rate or more with the opportunity that you can apply capital to it. So there's that caveat, but generally most things the growth rate declines over time. It's very rare that it accelerates. Occasionally it happens, but it seems to be rare unless something has happened in the business or a lot of capital has been applied to it.
Yeah, and so, but you'll still take a look at these companies that aren't. So what's the sub-metric you're looking for then? You said though they haven't applied a lot of capital. That makes sense. Is there a sub-metric that you believe will be exposed by the capital?
A couple of things. One is if it literally is all inbound and that you think that you can apply this outbound machine to it, if it's a business that makes sense. Secondly, they do have a couple of reps and they just haven't, this is a little bit the later stage, they just haven't hired enough of them, but they're really productive. We benchmark all of the different kind of rep quotas and whatnot and how they might benchmark against that. What's their cost to acquire the customer if it seems low? Is their cohort growth really good? Is there something happening where their customers are just growing on their own for some reason in the market? So there's other reasons that we might look under the hood to see if there's something in there. But generally speaking, you want to see that tripling and then doubling kind of, on the next round.
The land and expand piece, I think, is super critical for any SaaS business. We've had some companies where they've sold a lot of pilots, and so you're not seeing that initial growth rate, but then you have huge ACV potential in this.
So you'll invest in pilots, right?
Yes, if we believe that there's multi-million-dollar ACV deals out there, absolutely.
Right. Or they've gotten in at a department level, and you think it can expand throughout an enterprise.
Yeah. So let me touch on a topic Stacey and I were talking about before backstage. Maybe Tomasz, you can kick it off because it's so important to folks in this room. Which is, it's related to the point Jason brought up of all this expansion capital, right? Which is, how much can I spend to acquire a customer, right? And we made up actually Stacey's partner Rory, who helped me think through the 1 to 10 and 5 quarters. I didn't realize he made up magic number, almost half joking, based on Omniture's growth, which he thought was magic. And a lot of us maybe hopefully have heard about magic, and I believe there's no magic to a magic number.
There is no magic to the magic number.
Atlassian's...
There's a new magic number.
But Atlassian's magic number is not HubSpot's magic number, which is not SteelBrick's magic number. Right. So there is no... magic does not fit all. But we're in this weird world where if we're not capital constrained and we're not going public next quarter, maybe I can spend 8 quarters of cash to get a customer back, right? And maybe I cannot do it. Maybe it's even okay because I get a whole bunch of customers for free, right? Because I have a brand. Why can't I spend? And so it seems like we look at these companies that are burning epic amounts of capital, right? We even look at Box, where we have investors, and I'm a huge fan. But Box burned a lot of capital, right? What's okay? How should folks think about this? And how do you think about it vis-a-vis your competitors? Right?
Yeah, I mean, I think.
And what's going on?
Yeah, so the median, the metric I care most about when evaluating this is months to repay back the cost of customer acquisition on a gross margin.
As a blended
basis.
number.
As a blended number.
Right. Okay.
And the median for startups is somewhere around 11 to 12 months, and the median for publicly traded software companies is 15.
Okay.
Yeah.
15.
Okay. 15.
So, but I'm Looker. Let's say I do a $150 million Series D. Like, how can I push? What am I allowed to push? Where should I put? What can I push?
Yeah, I mean, I think so. So this is the way I think about it. So right now, private market multiples are 2x public market multiples on SaaS companies.
Yep.
You can raise in the private markets at 15 times forward, let's say, and the median publicly traded SaaS company trades at 7.5 times forward, 5 times forward, somewhere in there.
Yeah.
And the company always needs to be in a position where if multiples were to halve, on a multiples basis, they could raise an up round. And that's how much runway, that's the minimum amount of runway that company needs.
Yeah.
And so that's how I'd back into how much on an absolute basis I'm willing to burn per month. Yeah. Right? On a unit basis, totally different ballgame, right? Function of LTV, churn rates, customer expansion, all that stuff. But if you're just looking at like raw, this is X number of $1 million going out the door every month, that's the way I'd back into it.
Yeah, but Stacey and then Jason, so I go to some event like here, or I go to Dreamforce, and my competitors, like not that much bigger than me, spend $1 million on the booth, and they rented out the ballpark, and they raised $50 million from whoever, Scale and Friends, or not Scale, because you'd be critical of it. Like, how do I grok this? Like, there's no way that their magic number is 7.32 months when they just dropped $3 million at Dreamforce, but they just raised $80 million, right? Yeah. So and I'm competing. I'm here. Yeah. I'm either directly competing or I'm competing for the same dollars, right? In 2015, how do I think $4 million? What should I do?
That's the one question where I said that is a tough one.
Yeah, what do I do?
Because
are they dumb
scary.
with the platinum sponsorship at $4 million ARR?
It's hard, hopefully they're doing their marketing, their attribution on that and understanding what their return on that spend is. It's hard to calculate branding that they may be getting from it, but it's hard in that environment. I was thinking of that question when you asked it of how is there a different angle you can go on, because especially if it's a direct sales model or an outbound sales model, they'll just swamp you with the feet on the street. So you've got to find some other way to cost effectively go to market with some amount of capital to be able to do it. But it's a scary, tough one. I don't know if these guys had a good answer, because I frankly don't have a good answer. Because even if their product isn't better, they'll make it better with that money. They'll just keep churning it and try to tune it to make it better. And unless your product's 5x better, it's tough to compete, because you just won't be in the sales. Now, if there's other go-to-market strategies where you can utilize more of the Atlassian model that's super cost-effective, then it's okay. But if you're going head-to-head in direct sales and they've got 80 million and you've got 10, that's a challenge.
Yeah. And Jason, how do you think? You're a little bit concerned on this, and then you've done companies like Yammer.
I was going to bring up Yammer.
I don't think Yammer had like a 2-month magic number, near as I could tell from the outside.
We didn't, and it was very interesting, because I must admit I was a little concerned with the aggressiveness of the fundraising there and how aggressive we were investing.
He played it to.
But I asked David about that, and his comment was the least risky thing I could do was to raise as much capital as I could and dominate this segment, because there were dozens of competitors.
Dozens.
Yeah. And they separated from the pack. And Josh James did this at Omniture as well,
he did
right?
The same thing.
And he's doing the same at Domo. I mean, there's a methodology and a process here where if you can raise the capital and you can invest it appropriately, you should be as aggressive as you possibly can. The only caveat there is that financial markets can change, right? They can change dramatically.
Yeah.
So I think you never want to be in a position where you have to raise that next round of capital.
Right.
Where you could change. I think Box, we always talked about this at the board, we always wanted to be able to literally pull back the expenses and never have to raise any more capital. But as long as the capital was available at a relatively cheap price, we're going to keep on investing aggressively.
But so let's just have a little fun with Yammer. And Yammer's interesting because it was a long time ago in internet time, right?
2012.
Yeah, 2012. This was just as this phenomenon was happening, right? Was there even a magic number at Yammer?
No.
Okay, so let's talk for a minute about how Yammer deployed sales and marketing capital. What was because we've got some pretty smart people there.
We grew.
Right?
We grew probably. I think we hired 250 salespeople in about 2 years.
So was it just budgeted by how do you do that math? Because there's no magic number here.
There wasn't math other than the fact that when we got into a customer, we knew that they were happy, they were engaged, and they were paying us more every year. Yeah. And so the more of those that we could acquire as fast as possible, we knew that there was going to come back in a return on that. And I tend to think, I mean, the payback is super important from an efficiency perspective, but it's not the most important thing, I think, in terms of creating value, because the value creation is all about what do you get back from investing those dollars. Yeah. And if you can get $20 for every dollar you invest, I don't care how long it takes to you to pay it back. Like, make more investments as long as you have those dollars available.
Yeah, but in an early stage, in an early stage, you also need to understand the churn rates, right? Like, you can't make a long-term bet.
Churn is critical, right? I mean, if you're not selling more to those customers the next year, I mean, Box sells 125% of the prior year every year, right? Yeah. That's a beautiful thing. It's the gift that keeps on giving.
Right. So that's what the point I was going to make, is that the cohort growth, if you can get it, and if there's a switching cost. I remember this with Omniture, where they felt like if another customer was going to win that deal and they didn't win it, it was 2 years before they got a chance at that deal again, and they had 20% cohort growth also with their customers, because they were based on just internet growth is how they're pricing. So they felt like they had to win those deals. So I feel like if the market opportunity is there, you have to go for it because you want to grab those customers. So you might be willing to spend more to get there because you've got the cohort growth to get it, and the switching cost. If you don't win it now, you may never win that customer.
I mean, if you look at the iconic technology companies, say Amazon or Salesforce, they've invested aggressively every single time. I mean, they've had the choice to invest or pull back. They've invested. They've invested.
But for the folks in the room, let's follow up a little bit on the Yammer as a case study, or pick something similar, because this is what confuses me. What's a realized quota at Yammer running up that hill, right? I mean, you hire 250 reps, okay? Yammer's ARR was not enormous when it exited for $1.2 billion, right? So what the realized quota is horrific on these reps, right?
Yeah,
just by definition.
They're all ramping.
They're all ramping.
They're all ramping.
So how do you even from folks here who have many of them who have to live in the real world, right? How do I think about, how low can I lower a quota, right? Can I have a rep with a 150K realized quota because I want to win the world, right? You have to have a spreadsheet. Maybe David didn't have a spreadsheet because he was dominating the world and he was really a B2C guy, but don't I have to have a quota, or how do I think about this, right?
So part of it was we brought a guy on from Salesforce who knew the methodology, knew the process, knew the numbers, and we had a group of reps that were doing extraordinarily well before he came on. Yeah. So we had the unit economics of a rep that we knew were working. Yeah. But we just decided, okay, it's working. We're going to put the fuel on. So, but you're right. All of those new reps were not paying off.
There was not full quota attainment.
Absolutely not in that first.
Do you guys have any thoughts, or Tomasz?
No, I mean, I feel like Yammer didn't get its chance to see it come because it got acquired on its way to the success. So it's hard to know how the tape would have played out.
Competing with a company that appears to have no realized quotas, right? It can happen, right?
Yeah, they were going for the market domination play.
And by the way, tell me about the number 2 player in the social enterprise space, and what they sold for.
I'm not saying it wasn't worth it. It's just,
I mean, it's not fun being number 2 or number 3.
But we don't have a founder-only audience here, right? So I'm also playing. It's very confusing when you have a well-run SaaS company. Yeah. I've got my reps have $837,000 mid-market quotas. Right. They're achieving 111% of quota overall. We're killing it. We'll be cash flow positive in Q2 of next year. And then there's a Yammer in my space, and I'm doing the math with 250 reps. They're hitting $43,000 in quota attainment, but it's working at a venture. Yeah. But it's hard to grok that, right? Not only for founders, but for folks doing real work, right?
I think the thing that you said, Jason, makes the most sense. Like, I think David Sachs realized that he was in a winner-take-all market, right? And so, in a certain sense, or maybe this is retrospective history, but in a certain sense, he knew that if he achieved total domination, he would take 80% of the market cap of that space.
And that's what's happened in most segments, right?
In most segments, particularly when there's one company that raises a disproportionate amount of capital, right? Yeah. And maybe in those cases, and particularly in bull markets where you've got these huge forces, like a tripling of the total amount of money deployed by venture capital investors, that makes sense, right? But I think if you were going to take a look on, if you were going to run the numbers and say, I'm going to start a business and I'm going to create a sales force not based on total domination, but to create a fast-growing but sustainable business, I think your minimum quota, minimum quota's got to be like 400K.
Yeah.
We should run the numbers. And the quota attainment's really got to be around 75, 80%.
I would agree with that.
And so that kind of, 250 people in 2 years is astounding. I've never heard that stat. It's amazing. But I think, most even fast-growing companies, they're hiring like 3, 4, 5, 6 AEs a quarter, maybe more as they scale up. And those are for fast-growing businesses. Don't get me wrong; those are companies going 300, 400%.
Yeah.
And they're just, they're waiting. They're not putting the cash into unramped account executives.
So Stacey, let's do a micro case study with you. Let's do HubSpot, which obviously you know well, and we've got Marketo, we've got Pardot, which came out of nowhere and is an aggressive competitor, and then a bunch of other tier, like I'm not going to say second, but it's not a 99% revenue to one player, right? So how do you think about these expenses and CAC and all this stuff in a concept of HubSpot, which is a huge winner, right?
Right. Well, I think that market bifurcated in terms of high end. Eloqua is at the high end. Marketo is kind of in the mid, and HubSpot has always been kind of the SMB broad platform. So for a while they weren't a marketing automation play initially. They kind of moved into that space over time as they added functionality to their products. So that was one where the market bifurcated on kind of different tiers of customers. Now, HubSpot will hit Marketo in customer bake-offs, but I don't think Eloqua, they rarely ever hit Eloqua, just because of where they play. So that one, the market split nicely, and you had multiple winners in that market. But in most cases, I was thinking of the earlier point, I was thinking about our investing strategy. When we're looking at a market and say the highest funded competitor has raised $100 million, and we're looking at 3, 4, 5, we don't really, sometimes we'll just say, okay, we're not investing in that market because we're fearful of that going up against that, $100 million competitor. But I think in that market, it was a different time. And so multiple winners emerged with, I think 2 of those were, over $1 billion market cap. And then we saw Pardot through ExactTarget, which was acquired by ExactTarget. So they took no venture capital. And then ExactTarget picked them up for $90 million, I think it was, and now it's a big part of Salesforce.
Yeah.
ExactTarget was a great example of a company that was very capital efficient.
Very capital efficient.
Probably the first 7 or 8 years of its life, right?
They raised, I think, about $8 million to get to $80 million in revenue.
Wow.
So they were super capital efficient, much more the steady Eddie kind of approach, and ultimately, I think, ended up to being the largest company, but it was over a long period of time. So a different model than what we're seeing today.
And by the way, for investors, it's not great to raise all that capital for us, either, because it creates
you don't
a lot
to do your super pro rata at $1 billion pre?
It's painful, the dilution and the amount of checks that you have to write.
Yeah.
We much prefer, we have a company named Viva raised $6 million of invested capital to get to be a public company. And that's great for the founders and it's great for investors. If you can pull that off, do it all day long.
Yeah.
So.
And we're going to run out of time, but let's just a few quick thoughts on that. Obviously, as founders, we'd love to have no dilution, right? Atlassian founders own what, 70, 80% of something like that, right? And then how do we know what path or journey we're going down, right? And because if I'm going to sell 85% of my company or 90%, and it happens, you sell 90% of your company, right? It takes you 13 years. You go through 4 or 5 CEOs. Pretty soon, it happens, right? How do I know how to manage that mentally process? Any advice, right?
Well, I think when you take venture capital, you're kind of aiming high.
You're aiming high, yes.
And you're going for size of the pie, and I think that's the mentality you have to have. And you try and maximize or optimize around minimal dilution for everybody, but ultimately, it really is the size of the pie that matters in that scenario. So, otherwise, I always say bootstrap your business. Don't take any venture capital and own 100%. That's another great strategy. But don't get stuck in the middle.
Yeah, stuck in the middle, right?
That's Death Valley.
Yeah.
So.
But it can be hard to see the middle sometimes, right? I come out of YC, I'm super hot, I raised $3 million from friends at 12 pre, and then the VCs give me a few more millions of dollars, and then I'm down a path, right? Sometimes even before I'm really out of the nursery, right?
Yeah. Or you have market execution where you were growing 200%, then 100%, and then suddenly you hit 60 and you're only at $15 million, and you kind of fall into that zone where it can get more difficult. So you had all the high growth, but maybe it was execution issues. Who knows what happened? But you kind of got stuck, and you weren't growing quite at the same pace.
So, any last advice on not getting stuck in the middle?
Well, if you are stuck in the middle, it's not the end of the world, but make sure you have the cash to keep going and that you don't need access to the venture capital. I think that's the way to survive if your growth rate isn't attractive to VCs. And there are VCs that will fund you. It's not, I mean, we're looking maybe for the high growth ones, but I know VCs that are looking for more of that, not super high, fast growth, take less capital, that type of dynamic. So
if you're growing, whatever, 50, 60% a year over 5 years, you're going to 10x your business. So
yeah, you're going to get there.
You're going to get there.
Right.
Just be
Because
patient.
competition isn't killing you.
Be patient and don't pay attention to the rest of the noise.
yeah, and don't require a lot of capital to do that.
And then have a conversation really early on with your founders, your co-founders, about exactly what your plan is.
Yeah, that's super
because
important.
if you have two founders with very different points of view,
That's
cause a lot of conflict.
great.
Yes,
Great
I've
suggestion.
lived through that. All right, this was epic. Thanks to our panel. This was really great. Yeah.